Hi, and welcome to Cymax FinTech Weekly Market Insight. We have just changed the format slightly, so now we've broken it into four parts. Part one is where we look back at what happened last week. First of all, our disclaimer. So trading involves the potential risk of loss of capital. Trading is not suitable for everyone, although obviously we hope it is for you. Any companies that are providing you with leverage, be aware you can lose substantially more than your initial investment. And any views, opinions, news, everything that we add in here is just purely for educational purposes. We're not trying to encourage you to trade or invest. That must be your decision. And of course, before you make that decision, consider the risks involved, your financial situation, definitely your level of experience and risk appetite. And of course, only risk capital you're prepared, but more importantly, you can afford to lose. Just make sure you've got plenty of savings and you're not risking that. Any doubts whatsoever, then seek independent financial advice before you risk that capital. Really important. Okay, so in this part one, we're going to look back at what happened last week. So the banking crisis has calmed down. There were slight concerns over Deutsche Bank, but they seem to be clearing up for the moment. The only probably real action there was the fact that Charles Schwab was downgraded. There were still outflows from the small and mid-sized banks to the Titans, the Wall Street Titans, as you would expect. But of course, it's so easy, just a click of a button, and whether you're on your phone or your laptop, and you can just move your cash around. It's crazy. Gone are the days of queuing up to try and get your money out of the bank as cash. So regulators are looking to tighten rules now, especially for the mid-sized banks. If they get a little bit sort of too tight on the whole banking sector, then we could sort of potentially have a credit crunch coming. Now, in the US, GDP was more or less in line. Jobless claims was a little higher, and I'm starting to pay a little bit more attention to them now because I've got the feeling they're going to start to creep up. Friday we saw Chicago PMI higher, but Michigan consumer sentiment was lower, so a bit mixed there. But PCE on Friday came in up 0.3% month on month, which is not bad. It's still 4.6% year on year though, and that's the core. So obviously that's still more than double the Fed's target rate. So, but the stocks reacted positively, and they ended up on the week's highs. Nasdaq's in fact this year's high. Housing data did improve, but there was a big oil inventories drawdown of 7.5 million barrels. In the UK, GDP just managing to keep out of recession territory, 0.1% quarter on quarter, which is 0.6% year on year. House prices dropped again as expected. Now, the UK managed to sign an agreement, the CPTPP agreement, which is a trade deal with 11 other countries. So, that is a positive. Andrew Bailey, however, warned that rates may need to go higher than expected as inflation was still way too high. UK still double digits. In the EU, sentiment overall was lower than expected. Inflation did drop, but obviously, just due pretty much to lower energy prices, although that could change in coming weeks now. When we look at it, most countries' services and food still remain elevated. Core CPI for the EU was up 1.2% month on month, which is 5.7% year on year. And their headline inflation 6.9% year on year. In Germany, IFO came in better than estimates, although consumer confidence fell more than forecast. negative 29.5. And retail sales again were poor, so they're actually down on the year, 7.7%. Spanish inflation again was lower due to cheaper energy, and retail sales 4% year on year, so not so bad for them. In China, both the PMIs were better than expected. Australian retail sales disappointed 0.2%, but CPI came in lower than consensus at 6.8%, which is quite a big drop because previous it was 7.4%. Japan data came in steady. It just seems as though probably Ueda will possibly move away from negative rates by the summer. Of course, we'll have to wait and see on that. But the markets were strong. They certainly ended the month, and Friday was the end of Q1 as well, strong. Whether that can continue, we'll have to wait and see. But Nasdaq actually returned to a bull trend. It's recovered just over 20% from its lows. So that's it for this part. Please tune in for part 2, where we can look at what's going on next week.